While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen.
Fed Chair Powell pointing to a weak labor market as he hints at a further rate cut this month. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks advancing after 3 days of losses as optimism of a Fed rate cut outweighs renewed U.S.-China trade tensions. President Trump says the U.S. may stop importing Chinese cooking oil over Beijing's refusal to buy American soybeans. But his trade representative still expects talks to ease tensions. For market perspectives, we have two top money managers coming up. JPMorgan Asset Management's Rasid joining us in a moment, and later we speak with Goldman Sachs Asset Management's International Head of Strategic Advisory Solutions, James Ashley. And here's a quick check on the markets. Asian stocks are rebounding after 3 days of losses despite renewed U.S.-China trade tensions. The trade angst taking a backseat as optimism of a potential Fed rate cut in October lifts sentiment. Fed Chair Powell citing the low pace of hiring and noting that it may weaken further. Now, here's what he had to say.
The labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out.
Chinese stocks also in focus after new data showed price declines persisting. September consumer prices dropped 0.3% year on year. Factory gate prices also down 2.3%. The yuan, by the way, being supported by a stronger than expected fix. Now, aside from deflation woes, China is also grappling with fresh trade threats from Washington. President Trump says he's considering halting cooking oil imports in retaliation for Beijing's refusal to buy American soybeans, which Trump calls an economically hostile act. For more on this, let's bring in Bloomberg Managing Editor Jill Deeses. And Jill, it's again tit for tat, Trump threatening to take more action.
Yes, that's right, Haas. I think, at this point in this unfolding, these tensions that we've really seen between the U.S. and China over the last week or so, you're looking at just yet another threat from Donald Trump involving this Chinese cooking oil. Now, this, of course, in retaliation potentially for the fact that China hasn't bought any U.S. soybeans. China, the largest buyer of soybeans worldwide, hasn't bought anything from America this season. That's something that, really does kind of show that there continue to be these trade strains between these two countries. Now, whether or not, withholding or, sort of stopping that purchase of that cooking oil is something that operates as, massive leverage, I think that's really an open question here. But I think what this does show you is that in combination with everything else that we've seen over the last several days, whether that be, certain maritime curbs involving shipping vessels, whether that be, some of the rare earths export curbs that China announced last week, we're still looking at quite a bit of tension heading into what we're expecting to be a meeting between Trump and Chinese President Xi Jinping toward the end of this month.
The thing is, cooking oil is a new front in the trade war, right, Jill? The thing that we should note as well is that, China has been buying less and less of cooking oil anyways. I'm just wondering, is this all rhetoric leading up to the talks that you mentioned earlier? Is it just a way of, it's a bargaining chip?
Yeah, I mean, it could very well be, right? I think, the other thing to keep in mind is that the U.S. Trade Representative Jameson Greer has said that conversations over trade talks continue. Again, Haslinda, I go back to those issues over rare earths, which I think is a much, much bigger concern when it comes to how exactly these two countries really sort of relate to each other. Those curbs that were announced, those export curbs last week by China, I think really, really critical here, because that's the kind of material that the U.S. and others really need to develop a lot of advanced technologies, things like fighter jets, things like electric vehicles. So that's really something that I think is, a really key piece here, and certainly China's biggest negotiation tool. I think what we can expect to see over the next few weeks before, again, Trump and Xi are expected to meet is continued negotiations between these two sides, whether that actually results in a deal or something that sort of punts a broader U.S.-China trade deal further down the road. Again, I think remains to be seen. But, certainly what you're seeing over the last few days is, these two sides kind of, putting what they have out on the table. These are the types of bargaining chips that we have here. How exactly can they reach maybe some kind of an agreement?
Jill, thank you. Bloomberg Managing Editor Jill Deese is coming to us from Hong Kong. Let's get perspective on how the latest trade tension is impacting markets. JPMorgan Asset Management Global Market Strategist Rasid joins us now here in the Lion City. If you take a look at the market action today, what trade war? Markets rebounding from 3 days of losses.
Yeah, no, exactly. We saw it on Friday, what was happening. I think volatility is really just par for the course. I think right now when we think about the trade tension, we're still thinking whether it could be a negotiating tactic like what you've mentioned earlier, or is this just a longer term strategic change in priorities, right? And we do think that both sides really understand the issues around it and what a hard decoupling when it comes to trade could really mean for both economies as well. But when it comes to strategic technology, I think that issue becomes a lot more durable. So we could see more de-risking of supply chains. So basically maybe the US looking elsewhere for some of these rare earth mineral exports. But it is really, really important because it will stop, for example, production of autos, for example, in the US. So it is a really, really critical, and we do think could be a longer term issue.
How would you describe market sentiment right now? It's hard to make sense. Yeah. We saw a recent meltdown, and now we're seeing retracement of about 60-70% already. Those big movements, what are they due to?
Yeah, so we don't think it changes the investing principle for us at all, right? So we still, tell investors, stay very much diversified. What you saw on Friday's headline, it could be due to a combination of factors, right? It could be the 100% additional tariffs from US and China. It could be some investors de-risking because they might be overly allocated to a particular market, say US, and they're taking off some risk off the table. So there is a confluence of factors really happening. But what we are seeing is that rebound really reflects the fact that there are, in some investors, looking at this as opportunity to add back in as well, because you just take from a broader perspective what is really driving, what it's going to drive U.S. equities over the longer term. We think it's AI, right? So I think to the extent that such trade tensions, for example, could really affect and derail that AI trend, that's where we're going to start thinking, okay, so maybe we want to look at other potential winners of all this, whether you're looking at Asia tech, for example, so really diversifying the sort of over-allocation to U.S. tech.
Some clarity from the Fed. Powell saying that everything's on track. We're going to look at possibly 2 this year.
Yeah.
Does that change anything?
No, I mean, that was really very much priced in. Exactly. So that's pretty much priced in already. I think the fact that he didn't really do anything overnight during his talk to really kind of shift away from that potential cut at the end of the month, that really says something, that the conviction is there. It would take a really big upside to maybe the September labor report or the CPI report, which is obviously coming October 24th, to really derail that plans. But I think it's really pretty much done and dusted that we will be getting the 25 basis points cut.
Okay, one huge theme we've been talking this week, debasement trade. Are you buying into that? My guest yesterday said, yes, all in.
Yeah, no, I mean, again, it really goes back to what would really be driving long-term factors here, right? The kind of structural trends, whether you're looking at the U.S. as AI, in Asia as well, there's leadership in software, in semiconductors, etc., right? So that's how we're thinking about allocation from a more global perspective also. And we're not only equities, right? We're also looking at fixed income. We do think that there's a lot of trades over there as well. The dollar weakening could also mean it's great for some of the emerging markets, Asia fixed income markets also. So yeah, we're still a little bit more cautious on that and just really taking a step back and thinking what are the longer themes that could really drive asset classes performance.
So in terms of longer term, a weakening dollar trend will persist?
Yeah, so at least from our perspective, we do expect about a 4 to 6% further depreciation into 2026, and that's really underscored by the whole fading U.S. exceptionalism story as well. Potentially, if things really fall off the cliff, we could even see a further depreciation, but not to the tune that we saw year to date, which is the dollar index down about 10% year to date. Not to that sort of level and that amount of time, but it's really about that U.S. fading exceptionalism story into 2026.
You talk about diversification. That theme, that strategy has been ongoing.
Yeah.
Are you diversifying in a different way from 12 months ago?
Yeah, I think what's a lot more interesting, at least in Asia, we are finding opportunities away from the North Asians. I know the whole North Asian story is very well telegraphed. Korea obviously has seen a stunning rally so far this year, and I don't think that narrative around high bandwidth memory chips that has necessarily changed. That's still really very much part of the AI ecosystem. But I think also kind of bringing in that ASEAN story also here and there, where we're looking at more favorable valuations and also thinking about China. I know some people might have that skepticism around Chinese AI, but if you just look at the hyperscalers, we do think there's a lot of scope for them to run a lot more, especially if you compare the US hyperscalers and the Chinese hyperscalers as well. So yeah, there are opportunities in China, in ASEAN data centers, whether it's in Malaysia. We're seeing structural reforms in equity landscape even here in Singapore. So there are opportunities in closer to home.
But ongoing, I guess, tech war between the US and China. I mean, negotiations are still happening as we speak. I'm just wondering how you're pricing that risk into, the AI plays in China.
Yeah, so I mean, the thing about the Chinese AI play, and we've already seen, like I mentioned, right, the hyperscalers, for example, the top four, they're earmarked to spend about $50 billion this year, and that's comparison to about $300 billion for the top four hyperscalers in the US. So that scope to really expand is really there. And in China, you do have this sort of open infrastructure when it comes to AI, which means it's a very more collaborative environment. So if a particular company, for example, does something that really pushes the AI frontier in China as well, and we are already seeing it being, through online shopping, AI is embedded in that as well. So we are seeing some benefits of that. And obviously, again, when we go back to the very top of our discussion about AI really being a strategic technology priority for China as well, there is that certain push to really want to advance such AI technology within China as well. And that's really, to us, at least going to accelerate this frontier.
The big question is whether you get the returns of the investment you're putting in. That is still a big question. Even for U.S. companies, how are you assessing that risk?
No, that exactly. So, I mean, if you're going to ask us, what's one of that risk is really, we're hearing all this CapEx pipeline in the U.S. This company is spending this much, even in China as well. And so one may argue that optimism may have run ahead of this course, right? And that what if earnings do not deliver down the road as well? And so this is really going back to what we said, look, that diversification theme, it was what we said at the start of the year. We're obviously moving to 2026, and I think even more so right now that it's becoming a lot more relevant, especially around that risk if you're overly concentrated in a particular equity market.
Isn't it true that the way to play AI right now is to look at the energy space, the infrastructure of AI? Correct. Why still buy the overvalued, some say overvalued AI plays when you can actually play the energy space?
No, 100%. So, I mean, that's something that we're also have a lot of sympathy with as well. So you're talking about data centers as a utility play, right? For example, if you need cooling systems in your data centers, that's also a form of a utilities play as well. So industrials, utilities, these are sectors as well where valuations are a lot more favorable than your mega caps that we're all known over the last couple of months as well. So what we're saying is that just don't look at mega caps, just look at the broader AI ecosystem, even when we're talking about within the US and also outside of the US, because obviously it is a global supply chain. So even when we're talking about potential AI trade war, even if this whole trade war around technology becomes a longer term issue, and we do think that it could potentially be that, there's still winners and losers as well. So being very active when it comes to equities, stock selection is going to be very central.
How about Gold.
Yeah. So gold's a very interesting proposition. I think, if it goes into your portfolio, it's great as an inflation hedge as well. But right sizing it is going to be
5
very
to
important.
10% of gold. What are you looking at?
Potentially, it could go high. If you look at what is really driving the anchors of gold, it's really central bank buying that's not changed. So really diversification by central banks, right, on your asset side, really looking towards gold. And the retail segment for gold buying, that's really, really strong. Out here in Asia, right, China, India, to some extent even Thailand. So those anchors we think may not change, and it's going to be very supportive of gold. We don't know where the next geopolitical tension is going to come from. That's the truth of the matter. None of us are political analysts. But what we have seen so far is that they're becoming a lot more frequent. And in that sort of scenario, gold tends to do really well. So
is it the best hedge right now? Is it the best haven play right now?
It seems to be the case, given how market is really pricing it in, right? So yeah, there could be some more upside for gold prices as well, but really just right-sizing it, because unlike equities that really pay out dividends, for example, fixed income pays you coupon, gold doesn't. So right-sizing in your portfolio would be very central for investors.
Is it fair to say that you're expecting greater volatility from here? VIX at about 20 right now, quite a high level compared to previous months.
Yeah.
What are you anticipating in terms of vol?
So volatility is going to stay. I think that's one thing clear. What we do know is that obviously we're going to have the APEC summit at the end of the month, where we are going to see US and the Chinese policymakers meeting on the sidelines. We know that we have the investigations around the reciprocal tariffs on the Supreme Court ruling early November. Those are the things that we do know. There are a lot of things that we do not know, and that's the headlines that could come in that could really kind of inject that sort of volatility in the market. But that being said, that there are ways that investors could really mitigate that sort of volatility through diversification, not being overly allocated to a particular market, really employing some of their option overlay strategies, for example. So yes, volatility is going to stay, but that does not mean that investors should really stay on the sidelines.
Okay, so given the scenario you've just painted, your top conviction calls for the next 12 to 24 months?
And look, risk assets going to do well. I mean, at the end of the day, you are getting that Fed rate cuts coming through as well. The baseline view is
that EMs are going to be doing well too?
EM is going to be doing well because of that US dollar backdrop that we've already spoken about as well. We are getting the sort of global growth convergence where US slows is right now, but we do see other major markets.
Can they outperform developed markets?
It's tough, right? Because at the end of the day,
that's been the promise year after year.
Yeah, that is a promise that has not really delivered, unfortunately. But at the end of the day, is a developed markets demand that is really driving exports out here. And for example, if you take EM Asia, that's really our bread and butter, right? Exports to DM. So if you do see that developed markets demand starts to falter, that's really going to affect us as well. So what the question is whether is there enough domestic policy support out here in Asia that could really offset. To some extent, yes, but at the end of the day, the whole world has become a lot more globalized. Supply chains have become a lot more integrated as well. So it's really hard to see EM really outperforming US at the same time. But so, which is really going back to our core, right? US still remains that core equity allocation, but really diversifying, looking towards EM, etc., taking advantage of longer-term trends than that weaker dollar environment.
Wasn't too long ago that we really loved Japan too. Now that we have that political uncertainty, how does Japan stand in terms of the attractiveness of the market?
Yeah, so obviously Japan's going through some political issues right now. I think the important part is that how will fiscal policy really play out over there? So are we going to see a more accommodative fiscal stance, and what does it mean for certain sectors? I don't think we have much clarity around that yet. But at the same time, do not forget that we do have that corporate governance reform story that is still underway, right? Again, it's not going to be an overnight story. It is a longer-term story. Administrations, they do come and they change, but what we're trying to do over here is really to identify the longer-term trends. And part of it, at least in Japan, what the main driver has always been that corporate governance story.
Raisah, always good to have you with us. Come back soon. Raisah Rasid, Global Market Strategist at JPMorgan Asset Management. Still ahead on Inside, Pimco's Vice Chairman on navigating geopolitical shifts and market evolution. Hear that exclusive conversation next from the Cathay Asset Management Summit in Taipei. Keep it here with us. This is Bloomberg. Welcome back to Insight. The Vice Chairman of bond giant Pimco says the real conflict and challenge for the U.S. and China will be over the application and weaponization of artificial intelligence. John Studzinski spoke exclusively to Bloomberg at the Cathay Asset Management Summit in Taipei.
we talk about the decline of American exceptionalism, and we do believe that. What's interesting right now is, China has been extraordinary. We're now on the 15th five-year plan. Okay, so China is a very well organized economy. It's the second largest economy in the world, and they really, particularly now in terms of technology and green technology, they're brilliant. For the first time, you have an American president who actually has a strategy. He spent the previous year before running putting in place his cabinet and all the things he was going to do. And whether you like it or not, and I say it again, whether you like it or not, he's doing everything he said he's doing. So for the first time, you have the two largest economies, you have two leaders, both of whom have very strong views about their countries, their economies, and it's all, the area that's going to become the great tension, and you see this with Friday's announcement on specialty minerals, because specialty minerals, of course, is the major input for semiconductor chips and AI and digital. The real conflict and the real challenge is going to be how the two countries work together on AI and the applications of AI as it relates to a number of things, including the weaponization of AI.
In the face of all these geopolitics, there's also what we're seeing is the fiscal risk that doesn't seem to be going away, where governments are continuing to spend, borrow, and the like here. And we're seeing soaring public debt levels in a lot of developed economies. Where you look at the US, Japan, the UK, Europe certainly has been making a lot of headlines. And we've seen steeper yield curves all around the world. Do you think that it's justified, or do you think what we're looking at right now is things are looking a bit too steep right now?
Well, you've got to, the United States, depending on how the tariff income is used to reduce the fiscal deficit, the U.S., by the end of Donald Trump's term, if there is an end, it will be close to 40 trillion US dollars. Okay, and that is something you just need to keep in mind. And this is why people question the long-term resilience of the dollar as a reserve currency. So I think we can be concerned about debt, but I think it's a little too tabloid. I think there are, I think the White House has said the U.S. deficit will be manageable because the tariff income will be material. We need to see those numbers, and of course with the government shutdown, we don't have any numbers.
And that was Pimco Vice Chairman John Studzinski speaking to our colleague Yvonne Mann at the Cathay Asset Management Summit in Taipei. Still ahead, the power of diversification. Goldman Sachs Asset Management shares insights on the new market realities and risks that investors should be watching. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Billionaire investor Tudor Jones expects a Nasdaq composite to climb higher by the end of the year. However, he told Bloomberg that he's nervous about the concentration risks in the U.S. equities, particularly around the so-called Magnificent Seven.
My concerns are I see concentration risk everywhere I look. When now we have individual investors with the highest equity allocation they've ever had in the history of the United States, really 4 times that of the rest of the developed world. So I get nervous about that concentration. I get nervous about the fact that we have 35% of the S&Ps now concentrated in 7 stocks. I get nervous about the fact that this administration, even if all those decisions were smart and correct, again, if you just think about the number one rule of portfolio management is you want diversification. That's why our founding fathers created us as a democracy, not a monarchy, because you want that contestation of ideas. So I'm nervous when I see concentration virtually in anything. Again, whether it's in the stock market, whether it's the composition of the stock market, who owns the stock market, or the decision making that's getting made in Washington. It makes me nervous because I don't think in the long run, right? Even if all the decisions that President Trump is making are great, is that going to embolden the next president, who may not make as good of decisions, to do the same thing? So I'll look at that, and again, it raises caution flags for me.
But you're still long stocks right now? You're still long the Nasdaq?
I wouldn't say I'm long at this second. I'm clearly, again, I think there's such a confluence of possibly negative, possibly positive events. I think I want to kind of wait and see where we are in a week or two time. But my belief is that we'll be substantially higher by the end of the year.
And that was Tudor Investment Corporation's Paul Tudor Jones speaking with Bloomberg's Matt Miller. And those concentration risks, especially when it comes to AI stocks, are weighing on investors in the latest BofA Fund Manager Survey. A record 54% of respondents think tech stocks are too expensive. Last month, almost half had dismissed those concerns. Now, fund managers also flagged an AI bubble as the biggest tail risk ahead of other major concerns, including inflation, Fed independence, and dollar debasement. Let's bring in our next guest. James Ashley is International Head of Strategic Advisory Solutions at Goldman Sachs Asset Management. James, so are you concerned about concentration risks?
The way I think we address that is to think about where's the opportunity set in the broader sense. So for much of this year, we've been advocating for a down and out strategy. So saying there is meaningful upside in US equities, but there is more attractive returns when we look at global small cap, or when we look at emerging markets, or Europe, or Japan. That strategy seems to us still to make sense. So we see meaningful upside for US equities, even with the concentration that you're talking about over the course of the next 12 months. But we still think there are better opportunities in non-US markets, and therefore from a positioning perspective, we would prefer to take an overweight position in those other markets.
So in terms of geography, there are lots of opportunities outside the US. How about in terms of asset classes? I mean, he did talk about concentration in stocks. Is it time to rethink 60-40?
So I think there are three elements there in terms of how we think about positioning right now. Number one would be that we still think equities are the place to be. So in terms of our overall multi-asset positioning, we think having a cautious, thoughtful, dynamic overweight to equities led by international markets is still the way to go. The second piece, if you're thinking more thematically, would be to think about how that equity preference corresponds to the changing geopolitical realities. And therefore, when we think about economic security, which goes beyond the traditional definitions of security, it encompasses supply chain resiliency, energy security, all sorts of different elements, including cyber and AI, I think that becomes an interesting thematic play. And then if we think beyond the equity universe, in a world in which we have these seemingly structural inflationary pressures, even with central banks having eased and likely to continue to ease into the future, we're looking at yields that are far more attractive in many cases than they've been for a long period of time. So multi-asset income strategies encompassing both fixed income and the equity universe look attractive plays to us right now.
I want to pick up on a couple of things. Let's start with the US. You say it is not exceptional. Why not? Some say it's actually the best house in the neighborhood.
Look, there are some great opportunities in the US. We're certainly not talking down the US. I think what we've seen, though, is that for a long period of time, other markets have been beaten up quite badly, and for many cases for very good reasons. But there's some now improved growth and policy dynamics. So if we take Europe, for example, we've now had very meaningful policy easing from the ECB that will be feeding through to support growth into 2026 and beyond. We've now seen Germany and a number of other European economies loosening fiscal policy in response to some of these geopolitical realities. So for the first time in a long time, we now have fiscal and monetary dynamics that are pro-cyclical at a point in time where valuations are still quite compelling and attractive. So it's not so much talking down the US. As I said, to reiterate, we still think there is meaningful upside in US markets. It's about how these other markets look more attractive on a relative basis.
There has always been that gap between the US and European valuation, equities, and so on and so forth. That's gone on for like 20 years.
Yeah.
That's going to be different this time?
So if you look at where those valuations have got to, you're right, there has been a significant wedge for a long period of time, but the magnitude of that has now reached somewhat extreme levels. If you look at the PEG ratios, the PE ratios relative to growth rates, we're now at or close to all-time highs. So valuations have always had that discount, but that discount now is much greater than it has been historically. There's then a piece that says, well, why now? Even with that extreme valuation, could that not go on for a prolonged period of time? And that goes back to what I was just arguing, that I think from a monetary and fiscal perspective, we now have a dynamic in Europe that's the first we've seen being pro-cyclical unambiguously for a very long period of time. And
but what about the macro perspective, the political perspective? I mean, case in point is France. I mean, you know, it's still struggling with its leadership. It's still struggling with its budget. I mean, France will impact the rest of the region.
That's a fair challenge, and I think there's two elements to that. One is to say that when we talk about Europe, we're not taking Europe as a uniform, homogenous entity. We've got to be investing in Europe in a very thoughtful, dynamic way, understanding both the risks and the challenges and the opportunities, whether that's political or economic in nature. The other piece is to say that Europe is not unique in having political challenges. You could make the same statements about large parts of the Americas, large parts of Europe, large parts of Asia. So I think politics really matters for investors wherever they're investing right now. So from a European perspective, absolutely you're right to say that there are some meaningful challenges that have still to be addressed, and that I think investors have to have that top of mind when they're choosing how to invest in Europe. But it doesn't negate the opportunity set that we're seeing.
Meaningful challenges when it comes to the Chinese market as well. But when you take a look at the trade data, which was supposed to be weak, I mean, it came out way stronger yesterday, exports and imports. What do you make of that? And does that change your perspective on investing in China?
So our perspective on China has been constructive for quite some time. Go back to the thesis that we were talking about before.
Does that strengthen then?
In some ways it does,
conviction?
Yeah. The idea at the start of this year was to go down and out, and China was certainly part of that out story. So looking at non-US markets, that's where we were at the start of this year. That's still where we are right now. If we look at the growth dynamic in China, there has been some loss of momentum, but we're still talking about the services and industrial sectors that are growing at over 5% per year. As you said, the trade data outside of export to the US still look quite healthy. I think the authorities in China are still probably minded to look at technocratic, incremental and targeted measures towards further supporting the economy, that anti-involution push towards away from deflation. So we still think, even with the rally you've seen in Chinese assets this year, there's meaningful upside, What
do you play in China?
So I think the tech sector looks really exciting. I think high-tech manufacturing, that's certainly part of it, but I think it goes beyond AI. AI has become this moniker that we label anything tech-related as being AI. AI is certainly an interesting and exciting dynamic right now, but it goes beyond that. So I think high-tech manufacturing, I think technology more broadly, and if you're looking on a more long-term perspective, the burgeoning and affluent middle class in China is going to be spending more on consumer discretionary. So if you're looking for a longer-term trend...
But that's on the promise of consumption in the future, because consumption is still lackluster right now.
Absolutely. So it goes back to what I was arguing a moment ago, that I think the authorities in China are probably going to be looking at the inflation now from a perspective of how do we support a reflation of the economy, and that's why we get some more targeted easing measures coming through.
I know that you say AI has to be a bit more targeted. I'm just wondering whether the AI play in China is more attractive than the AI play in the US.
So go back to your first question, it's about concentration. I think in the US you've had this concentration of the AI stories about the Magnificent Seven. Now that's not true, but I think that's how many have perceived it. There is a more diverse and diffuse opportunity set. But certainly if we look at the opportunities within China AI, there's a whole heap of opportunities, not just in large cap, but small and mid cap companies connected to that tech and AI ecosystem that we think are really attractive.
James, I just want to highlight what's just broken in Japan. We've been keeping an eye on the 20-year JGB bond auction. That bond bid cover ratio is 3.56% versus 12 months ago of 3.25. I'm just wondering, what's your take on that? Of course, we weren't expecting a strong bid for it just because of the political situation. What's the sense you're getting out of Japan?
So look, take a step back from the minutiae of any individual auction, important as that is, and look at the big picture on Japan. It's one in which I think we look at Japan benefiting from some of these structural inflationary pressures that we're talking about. In a world in which you have demographics, technology, refragmentation of global supply chains, all these other inflationary elements that pose a challenge to policymakers in large parts of Europe and North America. In Japan, where we've had deflation for the better part of 4 decades, it's something that can be beneficial. Japanese corporates are now going to have purchasing power of the kind they haven't seen for a very long period of time. Valuations are still attractive. So when we think about that down and out trade in equities, Japan is certainly part of that, and it's not just a cyclical story. It's about how there's a structural shift towards a reflation of the economy that's going to be beneficial for Japanese equities.
So the BOJ not moving, never mind that we've been waiting forever, is actually a good thing.
I absolutely think so, yeah. So the BOJ have been trying to create inflation for 35 years. Why would they seek to choke that off? Now, there's a piece there about they want to make sure inflation remains under control, and therefore I think it's not unreasonable to expect the BOJ to hike incrementally further, but we're still in a world where, certainly compared to European or North American policy settings, the BOJ is likely to remain very pro-cyclical.
So what do you see the BOJ doing? Will it move in December, and where does it go from there?
I think more likely the early part of next year.
So none this year?
I don't think so. I think I don't want to stake our reputation or die in a ditch for that, but it's certainly when we're thinking about the policy dynamic, it's less sensitive to when do they hike. Is it going to be December? Is it the early part of next year? The big picture is, are they going to tighten further? And if so, how far? And that how far piece, I think, is the really important element. And I don't see significant further tightening from the BOJ on this point forward.
Do you think the BOJ is also looking at the Fed and what it does?
So, look, one central bank will very rarely, if ever, talk about what another central bank does. There's a common understanding there that you stick to your own knitting. But if we look at what central banks are actually thinking about, certainly currency dynamics have a big impact on inflation. So if the Fed is going to do one thing, then that's going to have an impact on what central banks elsewhere in the world do, because it's going to have an impact on their currencies as well. So the BOJ, I don't think, will talk about the Fed, but implicitly in their conversations, they must and they should be thinking about what the Fed is doing, because that will have an impact on the yen and, by definition, what that means for the Japanese economy.
And that leads me to my question. How do you see the yen trading from here?
I don't think we see significant moves away from here. So it's been bouncing around with volatility, but around the 150 level for a considerable period of time. We wouldn't have a strong bias towards a shift in either direction on that. So I think yen, where it is right now, remains probably a neutral play.
And yuan has been well supported. We know that PBOC was keen on showing that this is going to be a stable currency. Yeah. Will it continue to support?
I think so. I think that's something that's quite a high policy priority for the Chinese authorities, so we wouldn't see any significant shift in that dynamic.
What's the biggest risk for China right now, James? I mean, is it still the trade war between the US and China, the uncertainty of that?
I think it has to be that there's so much fluidity attached to that, the ability to make any strong call on how high those tariffs are going to be, how broad they'll be, how long they'll be in place for, and what does that mean for not only China's export sector, but the relative attractiveness of foreign direct investment going to China more generally. That has to be the immediate, it's not the only risk, but that I think has to be the immediate top-of-mind risk for China.
You started the conversation by saying that there are lots of other opportunities apart from the US. And when you take a look at Asia, India has been, I guess, a hot market, a hot IPO market. Are you looking at that in a big way?
So, yes, is the short answer. But for us, that's more of an equity play. If we look at the Indian equity market right now, there has been some fading in terms of valuations, but that for us gives an attractive entry point. If we look at the long-term dynamics, we're talking about India being the one major economy where we can envisage double-digit nominal GDP growth for several years into the future. And historically, that's translated through to commensurate equity market performance. And that's fueled by a number of measures. Demographics is an important part of it, but also a pro-reform agenda. Absolutely. So a number of pieces that feed into that. So if we're thinking about where within the emerging market landscape would we have less of a tactical view, but a long-term structural view about meaningful upside, India, I think, has got to be the first on that list.
Infrastructure plays as well? There's
Absolutely.
Lots of investments going into that?
Absolutely right, yes. And I think that infrastructure play is not unique to India. I would certainly endorse that, but it goes beyond that. If you look at large parts of Europe, perhaps also Japan, you see large amounts of infrastructure investment at play there.
Frontier markets may not be everybody's cup of tea, but they've done really well. You take a look at Pakistan year to date, up more than 40%. Of course, today, you know that the gains today pretty much has to do with the IMF deal. I'm just wondering, you know, what are your thoughts on frontier markets? Is that something that you should be investing more of?
In a way that I think is respecting the benchmarks and the volatility that are typically attached to those asset classes and those areas, that's an interesting play. I think there are a number of factors behind that. One is about the diversification of supply chains. When firms are thinking about how do we have a more robust and resilient supply chain, how do we diversify away from that all-in on China, moving to a China plus one model where we stay in China but also think about having some backup or parallel facilities elsewhere, a lot of frontier markets are going to be beneficiaries from that. We're also in a macro environment where the dollar has weakened very significantly over the course of this year, and we're talking about how far, not whether or not, but how far the Fed will cut rates further. That's quite a constructive macro backdrop for those markets. markets.
Okay, we talk about the dollar weakening, debasement trade. Are you buying into that or not?
No.
Why not?
I think what we're looking at is a different dynamic when it comes to the dollar. We're looking at a world in which the market is quite rightly saying, hang on, the fiscal dynamics look somewhat different. The policy predictability has diminished, at least in the short term. And certainly I think there's a change in the investor base. That's what's behind the rally that you've seen in the gold market. But if you're thinking about the debasement, I don't see what the logic or the rationale for that is. The US is still
pulling back from fiat.
The US economy is still one of the strongest performing, fastest growing economies in the developed world.
But not exceptional, you say?
Not exceptional, no. And that's why I wouldn't be arguing for a rebound in the dollar. I think the devaluation, the weakening that you've seen over the course of this year is absolutely justified, but that doesn't mean that you see a further significant depreciation from this point forwards. I think the dollar on a fundamental PPP basis is relatively rich, so if you take a longer term perspective, some convergence back to the equilibrium value seems justified. But if we think about the productivity outlook that's attached to the AI trade, if we look at growth dynamics right now, if we look at all the factors that support the US, it still seems to us to be the most likely dominant currency, the reserve currency of choice for the far into the foreseeable future.
So James, putting everything together, just a final thought, what is the new reality that market participants are dealing with?
I think there are two things, two structural elements. Number one would be how we are moving from a world of unipolarity to a more multipolar, fluid geopolitical environment. That has implications for currencies, as we were just talking about, but capital flows, relative market performance. The second piece that attaches to that is that there are structural inflationary pressures. Some of that comes from the increased spending on defense and security, but it also relates to technology, to the rebuilding of supply chains, to demographics. But those two elements of higher inflation or higher inflationary pressures and what that necessitates from central banks to suppress inflation and the changing geopolitical environment, I think requires to go back to first principles and think about how do we build a fit-for-purpose, diversified multi-asset portfolio.
Great perspective, James. Thank you for popping by. James Ashley, International Head of Strategic Advisory Solutions at Goldman Sachs Asset Management. Coming up, China's stepping up its submarine game and the US is racing to catch up. We'll dive into today's big tech next. Keep it here with us. This is Bloomberg. Welcome back to Insight. Submarines are a vital asset for any country's navy, and for decades, the U.S. has maintained its undersea superiority. But with production delays and a labor shortage plaguing the industrial base, it may be in danger of losing its edge. That's as China is rapidly building up its submarine fleet, opening up a new front in the superpower rivalry. Well, Bloomberg senior producer Ryan Chua joins us now for more on today's Big Take. And Ryan, just how severe are the problems facing the U.S. submarine industrial base today?
Well, it's quite a massive issue, and U.S. officials are becoming increasingly concerned. We're talking here about $2 billion next-generation submarine programs that are both facing significant production delays. So on the one hand, you have the Columbia-class ballistic missile submarine, one of the most powerful in the fleet and will be the largest U.S. submarine ever built. The first of 12 boats in that class will be delayed by 12 to 17 months. And then you have the Virginia-class attack submarines, which will form the majority of the U.S. fleet. Now, the latest boats in that class are facing delays of 24 to 36 months. So the worry here is that the U.S. won't be able to produce enough submarines, not only to replace the existing ones in their fleet that are aging and are due for decommissioning in a few years, but also to be able to maintain its undersea advantage. So the Navy's goal has always been to be able to build one Columbia-class and more than 2 Virginia-class submarines a year, but it hasn't met that target yet so far.
What's causing these delays, Ryan?
Well, it's a confluence of factors, but according to the experts we spoke to, one of the biggest is really a shortage of skilled labor. There's just not enough people right now working, or skilled workers rather, working for the industrial base. Now, we do know, it's hard to put an exact figure as to how wide the gap currently is in the workforce, but we do know from congressional reports that the shipyards, for example, several of them, are facing attrition rates of as much as 30% for some skilled trades. And the problem is there's not enough new people to replace them. So the Navy has really been ramping up recruitment and really boosting efforts to get to attract more people to work in shipyards and other companies involved in submarine construction and their suppliers. And we do know from the Navy that the need is quite pressing right now. They need to hire or be able to hire some 140,000 workers over the next decade to meet this growing need for not only submarine construction, but submarine maintenance. And speaking of maintenance, it's another problem that's compounding all these issues. The shipyards, there's just not enough shipyards right now, and so there's a huge backlog when it comes to maintaining submarines, so much so that there's one attack submarine, the USS Boyce, that has been sitting in a shipyard and awaiting repairs.
140,000 is a big number. When it comes to China, though, Ryan, how close is China to catching up, and why are U.S. officials and experts so worried about it?
Well, we have to know that China doesn't publish official figures regarding its naval capabilities. So what we have are independent assessments and intelligence reports. And what we've seen from the numbers out there is that China is rapidly building up its undersea fleet. We're talking here, according to one study, about a rate of building 4 to 6 nuclear-powered submarines a year. And the U.S. Defense Department's own assessment says that China will be able to have about 80 submarines in its fleet come 2035. So it's really causing worries in Washington, aside from the fact that China has been investing a lot in R&D and upgrading its shipyards.
Ryan, in about 30 seconds, we know you visited a U.S. Navy-funded training facility in Virginia as part of your reporting. I mean, what did you see? What part does it play in revitalizing U.S. submarine building?
Yes, this is a 100,000 square foot facility in Southern Virginia called the Accelerated Training in Defense Manufacturing, quite a long name, but basically a part of efforts to boost submarine workers' development and hiring. So students there get trained for about 16 weeks, and eventually they get hired in this vast network of suppliers and companies involved in the submarine industrial chain and the industrial base as a whole. And the hope is that they will be able to address this massive workforce shortages that are plaguing the industry.
Great work, Ryan. Senior producer Ryan Chua in Hong Kong. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.